Welcome to Unlocking the S&P 500, a gateway to American industry. The world of investing can seem like a labyrinth. But what if there was a simpler way to tap into the heart of the American economy? Enter the S&P 500, an index that tracks the performance of 500 of America's largest publicly traded companies. It's a benchmark, a measuring stick, and for many, a cornerstone of their investment portfolio. Imagine owning a tiny slice of companies like Apple, Amazon, and Tesla, all through a single investment. That's the power of the S&P 500. It offers a diversified way to participate in the growth of corporate America, making it an attractive option for both seasoned investors and those just dipping their toes into the market. But like any investment, it's not without its nuances and risks. By the end, you'll have a clearer understanding of whether investing in the S&P 500 aligns with your financial goals. So, buckle up as we embark on this journey to unravel the mysteries and opportunities of this powerful investment tool. Let's delve into decoding the S&P 500. 500 companies, endless possibilities. The S&P 500, also known as the Standard & Poor's 500 Index, is like the all-star team of the U.S. stock market. It represents about 80% of the total value of the American stock market, making it a reliable indicator of the overall market's health. Imagine a giant basket filled with stocks from 500 of the largest and most successful companies in the U.S. across a wide range of sectors. From technology giants like Apple and Microsoft to healthcare behemoths like Johnson & Johnson, the S&P 500 captures the dynamism and diversity of the American economy. These 500 companies aren't chosen randomly. They're carefully selected by a committee at Standard & Poor's based on strict criteria, ensuring that only the most robust companies make the cut. When you invest in the S&P 500, you're essentially betting on the continued success of these companies, and by extension, the American economy as a whole. Now let's explore riding the market wave, how the S&P 500 works. Unlike buying individual stocks, which can be as unpredictable as a roller coaster, investing in the S&P 500 is like riding a steadier, more predictable wave. The S&P 500's value is calculated based on the market capitalization of its 500 constituent companies. Market capitalization is simply the total value of a company's outstanding shares. So as these companies grow and their stock prices increase, so does the value of the S&P 500. When the economy is doing well, most companies in the S&P 500 tend to perform well, pushing the index's value higher. Conversely, during economic downturns, the value of the index tends to decline as company profits and stock prices fall. Despite short-term fluctuations, history has shown that over the long haul, the American economy, and by extension the S&P 500, tends to trend upwards. It's less about chasing volatile swings and more about riding the wave of overall economic expansion. Finally, let's consider the allure of diversification, spreading your bets, minimizing risks. Investing can feel like walking a tightrope, the potential for reward balanced precariously against the risk of loss. This is where the S&P 500 shines, offering investors a safety net known as diversification. Instead of putting all your eggs in one basket, or in this case, one stock, the S&P 500 allows you to spread your investment across 500 different companies. Imagine owning stock in a single company, perhaps a tech startup you believe in. While the potential for high returns exists, so does the risk of that company faltering. Now, imagine owning a tiny piece of 500 companies across various sectors. If one company stumbles, the impact on your overall investment is cushioned by the performance of the other 499. This diversification is inherently built into the S&P 500's structure, mitigating the risk associated with any single sector's downturn. Section 4. The power of long-term growth. Patience pays off in the S&P 500. In the realm of investing, patience is not just a virtue, it's a strategic advantage. The S&P 500, with its historical track record, exemplifies the power of long-term growth. It's not about chasing quick gains, but rather about letting your investment ride the wave of economic expansion over time. Imagine planting a tree. You wouldn't expect it to bear fruit overnight. Similarly, investing in the S&P 500 is a long game. Historical data reveals that the S&P 500 has delivered an average annual return of around 10% over the past century. This long-term growth potential makes the S&P 500 an attractive option for retirement planning, college savings, or any financial goal with a long-time horizon. By staying invested and riding out the market's inevitable fluctuations, investors position themselves to reap the rewards of compounding returns. Section 5. Navigating volatility, when the market takes a dip. The stock market is a dynamic beast, prone to periods of both exhilarating highs and stomach-churning lows. The S&P 500, while generally considered a stable investment, is not immune to these fluctuations. Understanding and navigating volatility is crucial for any investor, particularly those considering the S&P 500. Imagine a ship sailing on the open sea. Calm waters can quickly give way to choppy waves and even raging storms. Similarly, the market can be smooth sailing one day and a turbulent ride the next. Geopolitical events, economic recessions, even unexpected news can send ripples through the market, causing the S&P 500 to fluctuate. Instead of panicking during downturns, savvy investors view volatility as an opportunity to buy more shares at a lower price, potentially amplifying their returns when the market rebounds. Section 6. Weighing the risks, not all sunshine and rainbows. While the S&P 500 offers a compelling investment opportunity, it's not without risks. Understanding these risks is crucial before diving headfirst into the market. One inherent risk is market volatility. As we've discussed, the S&P 500's value can fluctuate, sometimes dramatically, in the short term. Another risk is economic downturns. Recessions, pandemics, or geopolitical events can significantly impact the market, causing the S&P 500 to decline. While the index has historically recovered from such events, these periods can be challenging for investors, especially those with a short-term investment horizon. Additionally, while the S&P 500 offers diversification, it's not immune to sector-specific risks. If a particular sector, such as technology or healthcare, experiences a significant downturn, it can impact the overall performance of the index. Section 7. The S&P 500 in recent times. A glimpse into the past. The S&P 500, like a seasoned traveler, has witnessed its fair share of historical events, each leaving its mark on the index's performance. In recent years, the S&P 500 has experienced a period of remarkable growth, fueled by technological advancements, low interest rates, and a generally robust global economy. However, this period of growth has not been without its hiccups. The COVID-19 pandemic, for instance, sent shockwaves through the global economy in early 2020, causing the S&P 500 to plummet by over 30% in a matter of weeks. Despite this dramatic downturn, the S&P 500 staged a remarkable recovery, regaining its pre-pandemic levels within months. As of late 2023, the S&P 500 continues to hover near its all-time highs, although concerns about inflation, rising interest rates, and geopolitical tensions have injected a degree of uncertainty into the market. Section 8. Gazing into the crystal ball. What's next for the S&P 500? Predicting the future of the stock market is a fool's errand, as any seasoned investor will tell you. The S&P 500, despite its historical track record, is not immune to the whims of the global economy and the unpredictable nature of human behavior. One factor influencing the S&P 500's future trajectory is the direction of interest rates. The Federal Reserve's decision to raise interest rates to combat inflation has created uncertainty in the market, as higher borrowing costs can potentially slow down economic growth. Another factor to consider is the geopolitical landscape. Despite these uncertainties, many analysts remain cautiously optimistic about the S&P 500's long-term growth potential. Ultimately, the S&P 500's future performance will depend on a complex interplay of factors, many of which are difficult to predict with certainty. Section 9. The verdict: is the S&P 500 right for you? The S&P 500, with its historical track record, diversification benefits, and potential for long-term growth, stands as a compelling investment opportunity for many. However, Whether it's the right choice for you depends on your individual financial circumstances, risk tolerance, and investment goals. If you're a long-term investor seeking a relatively stable and diversified way to participate in the growth of the American economy, the S&P 500 could be a valuable addition to your portfolio. Its historical performance suggests that over time, it has the potential to deliver solid returns, outpacing inflation and growing your wealth. However, if you're risk-averse or have a short-term investment horizon, the S&P 500 might not be the ideal choice. Before investing in the S&P 500 or any other financial instrument, it's crucial to conduct thorough research, assess your risk tolerance, and consider consulting with a financial advisor. Conclusion: your journey to smart investing starts now. The S&P 500, with its intricate workings and potential for growth, may seem like a complex financial instrument. However, by demystifying its structure, understanding its benefits and risks, and analyzing its historical and potential future performance, we've aimed to empower you with the knowledge to make informed investment decisions. Remember, investing is a journey, not a destination. The S&P 500, with its potential for growth and relative stability, can be a valuable tool on this journey, but it's essential to approach it with knowledge and caution. As you embark on or continue your investment journey, remember that knowledge is your most valuable asset. Stay informed, seek guidance from reputable sources, and never stop learning.